to cover them. Therefore, you are owing them. That's why it's negative. Now, you expect to pay cash flow, and the present value of cash flow you expect to pay over time, over the coverage period, is 795. That's not the cash flow, it's the present value, which is already discounted. It is positive because I'm paying it out, which reduces my negative. Now, invariably, I also adjusted for risk based on variability of cash flow. What I'm supposed to settle invariably with 795 in present world will be settled in excess of it by 40, which is additional non-financial risk that I've taken. When I net everything off, initially I have 205. Thereafter, I netted off 40. It reduces to negative 165. That negative 165, which is the summation of ABC, is what I consider as my fulfillment cash flow. And technically, this is supposed to have been recognized as a profit, because what this signifies is that I collected 1 million in present worth, or 1,000 in present worth, more than what I will set in present worth. Therefore, which means at inception, I should have recognized this profit. But they said no. Rather than recognize this profit, I create a contractual service margin, which is by way of like debiting that profit line to zeroize it and crediting a liability account, which I call contractual service margin, which is the unearned profit over the coverage period. And that's why I said -1 times that 165, give me 165. But if this has been positive, it means it's more or less a loss. The maximum will have been 0. Because by the time I multiply -5 to a loss, it will give me a negative, which cannot be recognized. And therefore, between negative and 0, which one is the maximum? Is 0. And that's what I was trying to explain. Which means by this convention, we have established a liability account to eliminate that day one gain or profit. And that is how we create CSM. Now, let's look at it for a situation of a loss. In a loss situation, I didn't price my insurance contract well. I priced it as £800. I have negative of £800. Every other factor remains the same with respect to my expectation for payout claims. And also my expectation for risk adjustment also. At the end of the day, my fulfillment cash flow is positive, which shows a loss. Loss on the basis that all what I'll pay out in present world is more than what I've collected. Now, if I have to calculate my CSM, this will be negative 35 and 0. But which one is the maximum between negative 35 and 0? It is what? Is 0. And therefore, what it simply means is that since I'm not able to do this, I'll be forced to recognize this 35 as a loss directly in my profit or loss. That is the basic principle 1 and 2 of the CSM. And that principle speaks exactly to what we call the principle of conservatism or the prudence concept. Okay, let's move further. Let's now look at subsequent measurements. Insurance business is almost invariably exposed both to impact of emerging experience being different to that expected, and to impact of assumption relating to future experience being different to that previously assumed. It stands to reason that CSM, the balance that represents unearned profit, ought to be updated to reflect latest facts and circumstances. IFRS 17 acknowledges both these classes of items by referring to them as changes that relate to future service. Now, the third principle, what does it tend to explain? It says that with some exception, which need not to be addressed at this level, the CSM must be adjusted for all changes that relate to future services and not with current service. E.g., favorable mortality update must increase the CSM, unfavorable lapse experience must decrease the CSM. Now let's see the reality. Let's assume our open CSM was 100. Interest accretion is the one we recognize as the insurance finance expense, which is unwinding of the discount. Remember, we've assumed a 5% discount rate. We'll now unwind the discount by multiplying it by the opening balance on the average. And that gives us interest accretion of 5, which means this is now 105. Now, based on the current estimate, there have been changes to this CSM because of future service, and it has increased by another 40. Which means there's a form of changes that is favorable to us because of favorable mortality assumption, and therefore it will increase our profits over the coverage period by additional 40 in the present words. When we add everything together, we have 145. 145 is now our adjusted CSM, which will now have to be amortized from year 1 to the coverage period. Now, let's look at Principle 4. Principle 4 speaks to issue of loss that may have arisen. And what is that? A contract that was profitable before and now become onerous. Now look at it. Occasionally, there may be unfavorable changes relating to future service that has happened to be larger than the CSM, even after accreting for interest. How should this be accounted for? The logic of IFRS 17 continues. The logic is simply conservatism. And what is that? Principle 4 says that when an insurance recognizes that written business that was previously expected to be profitable is now expected to be loss-making. That is, because of changes relating to future service, it must not be allowed to spread the expected loss for that business over time, and instead must recognize those losses immediately. It will do so by first extinguishing, that is, charging those losses to reduce the CSM, and then establishing a loss component that might be in excess of that CSM, and we recognize it immediately to profit or loss. Now, let us see the example here. Imagine our opening balance for CSM was £100. The accretion based on discount rate is 5%. We had £5 to £100, it gives us £105. But the changes to future service based on unfavorable longevity assumption has increased our obligation by 150. That 150 has wiped out our 105. Which means the first thing we do is to wipe out the 105, and we are still left with 45 loss, which make the business onerous. That 45 loss will immediately be recognized because of the limitation of zero, because we can't carry the loss forward. It's only profit we have to suspend forward. Therefore, all we'll do, we'll be forced to recognize CSM at 0, since we have zeroized it, and the excess over it, which is 45, will be recognized in profit or loss. Does it make sense?
Yes, sir.
If you have questions, you must ask. We are going to display it in the model we are going to build. Now, let's look at insurance contracts. You are the holder of insurance contracts. That is, you took a policy, and because the policy you want to share your risk, you ceded part of it to another insurance company. What happens in that situation? The principle discussed so far apply equally to insurance contract written by an insurer, as well as to insurance contract written by the insurers. However, in recognition of the fact that concepts such as unearned profit or onerous cannot apply to insurance contract held, IFRS 17 modifies some of these principles in important ways to better accommodate such contract. What we are saying is this: if you are the holder of insurance contract, that is, you ceded your policy that you have already underwritten with another insurance company, the principle of onerous or profitability suspension will not apply. The principle will be realigned as follows. Now look at how it's being realigned. With some exceptions, only one of which is deemed important to this introduction. When an insurer or insurer purchases insurance, it must not be allowed to recognize expected net cost or net gain for that contract immediately. Instead, it must spread the net cost or net gain over time, which means the same way you suspended the profit and recognize it over time, you will also suspend the loss and recognize it over time. Because insurance contract has some level of guarantee, unlike when you did not reinsure. In that manner, what happens? The present value of insurance premium payable is 600, which is the one you underwrite, and the present value of insurance claim recoverable is 480, subject to risk adjustment of 20, which is the maximum you can recover is 500. But what you have paid as premium is 600. Technically, you have a positive reinsurance fulfillment cash flow, which is a loss. Now, this loss, before now, supposed to be recognized immediately. But because it's a loss arising from insurance contract that has not yet expired, you are expected to spread the loss over the coverage period, thereby creating reinsurance CSM, which is against the principle of direct insurance that we have discussed with respect to CSM. CSM is supposed to be created only for profits, but there is an exception to it that it can be created for loss if that loss arose from reinsurance contracts. Does that make sense?
Mm-hmm.
Okay, that is that exception in that case. Okay, I want you to read this for us.
Okay, sir. CSM for insurance contracts held. The insurance CSM can only be recognized in the profit or loss statement on a gradual and systematic basis over time, as at when reinsurance services are received. At any given reporting period, the reinsurance CSM consequently represents the expected amount of costs or gains that have not yet been recognized for the group of reinsurance contracts in question. Just like the gross underlying CSM, the reinsurance CSM also needs to be adjusted for all changes relating to future services, with some exceptions. One important exception relating to Principle 5 concerns an issue relating to the interaction between gross underlying business and corresponding reinsurance held. Consider an insurer that has just written a loss-making contract, and as per Principle 2, recognizes an immediate P&L hit of 35 pounds. However, the insurer already holds an external reinsurance contract under which the contract is 100% reinsured on an original terms quota share basis. Principle 5 on its own would imply that a net gain reinsurance CSM of 35 pounds will be established and spread over time. However, this results in a timing mismatch. Even though gross underlying claims are effectively capitalized and recognized on day one, in recognizing the upfront loss, the corresponding reinsurance recoveries cannot be taken credit for immediately. The exception to Principle 5 is designed to avoid this mismatch from arising. Exception to Principle 5. If an insurer or reinsurer has purchased a reinsurance contract either before or at the same time as it recognizes a loss for a loss-making underlying contract, the insurer must recognize reinsurance income to offset in full or in part the underlying loss recognized. The insurer shall adjust the reinsurance CSM to reflect the credit for future claim recoveries. The insurer shall adjust the reinsurance CSM to reflect the credit for future claim recoveries has already been taken by recognizing income.
Okay, thank you. You continue with the expression at this level. Can you continue with the recognition of CSM in profit, and I'll explain it further.
Recognition of CSM in profit or loss. One final point of detail remains to be covered. Earlier, it was noted that the CSM can only be recognized in the profit or loss statement on a gradual and systematic basis over time, as and when insurance services are provided. Why is this required, and what does it mean in practice? Why is this required? IFRS 17 effects analysis answers this question best. 1, currently insurers recognize profit inconsistently over time. 2, the timing of recognition of profits for insurance services can vary significantly by jurisdiction and by product. 3, some insurers recognize profit immediately when an insurance contract is written. 4, other insurers recognize profit only when the contract terminates. 5, other insurers recognize profit over the duration of the insurance contract on the basis of the passage of time. Consider an immediate annuity contract with a single premium paid by the policyholder at the outset of the contract in return for fixed regular annuity payment for the remainder of the policyholder's life. The insurer that writes this contract expects to make a profit. Recognizing all this expected profit upfront creates a large disconnect with the fact that insurance service is likely to be provided over several years to come. Waiting for all this profit to be recognized only when the policyholder dies is problematic because companies would have to wait for several decades before being able to recognize a return on their investments. Recognizing this profit systematically over time avoids both extremes and enables the possibility for a reasonable link to be secured between the rate at which profit is recognized and the amount of insurance service provided over time.
Okay, now what we are saying here is very simple. Okay. Now what we are saying here is very simple. How do we recognize CSM? We are going to recognize CSM over the coverage period in a systematic manner. Now, if the coverage units within the CSM are evenly distributed, it will be easy to just spread it evenly, which we are going to see in the model we are going to build. But most times they are not evenly distributed. Therefore, you are going to use the ratio of the coverage units in each bucket or in each quote to amortize that CSM over time. And also the CSM continue to increase or change subject to unwinding of the discount, which is the accretion of interest, and also to changes arising from future services, whether positive changes or negative changes, as the case may be. And we're going to see that as we move on. Now, to demonstrate that also, let's look at this illustration. Okay, now looking at this illustration, you can see vividly here that we are looking at how do we more or less amortize the CSM. Okay, here we have more or less identified what is the expected sum in force and what is the coverage unit. We now use the ratio of the coverage unit to the total coverage unit of each coverage unit for each year to the total coverage unit as a proportion to amortizing the CSM. And what we have done here is to say, if the coverage unit provided in year one is, let's say, 100, coverage unit provided in year two is 90, and it's on a reducing balance basis like that, presumably, we then say 190, 80, 70, 60, all other things remain unchanged. That gives you total coverage unit of 400. Therefore, what is the ratio of 100 to 400 in year one, which is 25%? In year two, we have 90, and 90 is what is left out of many 300 because 100 has gone in year one, which means the ratio of 90 to 300 is 30. You do that up to you get to this fifth year where you have 60-60, where you'll have covered it 100%. Now, marginal movement between 25, 30, 38, 58, 53, and 100, we account for how you amortize your CSM to your profit or loss at the end of the day. Does that make sense to you?
Yes, sir.
Okay, and this is based on the fact that the coverage units are not evenly distributed. Otherwise, it would have been more or less considered to be divided by 5, which means on average, each year, you consider an equal fraction of the CSM based on the remaining coverage period. Okay, now let's move further to look at what this means in practice. Okay, what it simply means in practice is this. Look at this illustration. You have 100 plus the interest accretion 5, which gives 105. And we have favorable mortality assumption of 40. That gives us what? 145. as the adjusted CSM. Now, we expect that based on what we have done, based on the coverage unit in the earlier slide, we assume that in that year, only 10% is the amortizing ratio. And therefore, we are going to say 10% of 145 is 14.5. That 14.5 will be released to profit or loss as part of interest income or interest revenue, insurance revenue, sorry. And the difference, which is 130.5 pounds, will be carried forward to next year as the closing contractual service margin. And that is how we repeat those processes over the coverage period. Okay, but take note, this process does not apply to loss, except for loss that is attributed to insurance contract that is held. Okay. Now, furthermore, I want you to take us through this process of recognition of CSM as a summary to what I've discussed earlier.
Okay, recognition of the CSM in profit or loss. For all types of insurance products, the CSM at initial recognition for a group of written contract is calculated as follows. CSM at initial recognition. You add best estimate present value of all cash flows, that is inflows less outflows, both in the future and at the date of initial recognition, less risk adjustment for non-financial risk, and less the recognition at the date of initial recognition of any asset for insurance acquisition cash flows. Add or less the recognition at the date of initial recognition of any other asset or liability previously recognized for cash flows related to the group of contracts other than insurance acquisition cash flows. Note in this calculation, the present value computation is based on the appropriate IFRS 17 discount rate. Cash flows expected in the future should only take account of cash flows that fall within the IFRS 17 contract boundary. Cash flows at the date of initial recognition include initial premiums as well as directly attributable acquisition cash flows. The risk adjustment for non-financial risk reflects uncertainty about the amount and timing of the cash flows that arises from non-financial risk. The assets for insurance acquisition cash flows is a newly introduced concept under IFRS 17. The final item that relates to any other asset or liability previously recognized for cash flows is also a new concept under IFRS 17. The standard recognizes that there could be cash flows that companies have to record before the recognition of a contract. For example, a premium could be paid before it is due and before coverage period begins. This item consequently attempts to ensure that such cash flows are not missed from the determination of the CSM.
Okay, thank you very much. Okay, now we'll look out further to this CSM as such measurement, which we have discussed, and this also summarizes all what we have discussed, also with respect to insurance contract with or without direct participation features. Can you read that as we summarize this position?
Okay, so CSM at subsequent measurements. Unlike the calculation just covered for the CSM at initial recognition, which can be applied universally to all types of insurance products, different rules apply to the CSM at subsequent measurement, depending on the type of product in question. This point reflects a fundamental distinction that IFRS 17 draws between two types of contracts: insurance contracts without direct participation features, insurance contracts with direct participation features. Examples of contracts without direct participation could include non-profit term assurances or non-profit all-of-life contracts. Example of contracts with direct participation could include unit-linked savings business, or with profit policies. An important implication of this distinction that is relevant to the CSM relates to the different treatments IFRS 17 requires depending on the type of contract. Earlier, we noted the existence of some exceptions when describing principle 3. We can now make at least one of these explicit. For contracts without direct participation features, IFRS 17 prohibits the CSM for being adjusted for impact arising from changes in discount rate and certain kinds of assumptions relating to financial risk. However, there is no such prohibition when adjusting the CSM for contracts with direct participating features.
Okay, thank you. Furthermore, there are other summaries you need to look at. Okay. Can you continue?
CSM at subsequent measurements. Unlike the calculation just covered for the CSM at initial recognition, which can be applied universally to all types of insurance products, different rules apply to the CSM at subsequent measurements depending on the type of product in question. This point reflects a fundamental distinction that IFRS 17 draws between two types of contracts. I thought I've read this. Okay. Insurance contracts without direct participation features, insurance contracts with direct participation features. To start it more simply, IFRS 17 has been...
To state
it more simply, IFRS 17 has two different measurement models for the two types of contracts noted above. These two models are referred to in the industry as a general measurement model, GMM, and the variable fee approach, VFA. The existence of two measurement models implies that the CSM as subsequent measurements can diverge drastically over time. Since this can have a material impact on the amount and timing of profit recognition, using the VFA is not simply a matter of choice for companies. Instead, IFRS 17 describes the eligibility criteria that must be met to qualify for the VFA. Strictly speaking, the term general measurement model, GMM, or variable fee approach, VFA, are not actually terms used by the standard. This is jargon used in the industry to differentiate between the two non-simplified measurement approaches. Some companies prefer building block approach over GMM.
Okay, thank you very much. Now, we'll now look further to unit of account. Unit of account means how do you more or less aggregate contracts in each portfolio in order to create unit of account, which we'll use as a basis of amortizing our CSM. And I want you to read through this for us, and I'll further give you an explanation on it.
Okay. What is level of aggregation with unit of accounts? A fundamental principle of IFRS 17 is that the CSM needs to be calculated and tracked at the level of granularity of groups of contracts. The level of aggregation requirements describe how these groups of contracts are to be arrived at. First, an entity needs to identify portfolios of insurance contracts subject to similar risks and managed together. Second, those portfolios must be split into further groups based on their profitability. Finally, those groups must be subdivided into further groups such that no group contains contracts issued more than 1 year apart. Further subdivision beyond these basic requirements are permitted. Groups can comprise of a single contract if that is the result of applying these requirements. 1, policies must be grouped together and the standard gives some rules. 2, policies similar in risk that are managed together must be grouped. 3, the groups cannot cover policies written more than 1 year apart. This we can call cohorts. 4, each cohort must be split into groups of policies that are A, onerous or loss-making, B, those that will never be onerous, and C, those that might become onerous. Now 5, the unit of accounts or a group is a function of the one portfolio of contracts, time, and profitability. Now the last one, number 6, once a policy is assigned to a group or a unit of accounts, there cannot be a reclassification.
Now, I think if you go back to all what we have discussed today, we've discussed extensively on this, especially with respect to creating a portfolio of contracts, which means creating quotes within a portfolio. And I've told you that apart from creating a quote on the basis of onerous contract, profit making, and those that are profit making or likely to be onerous, you also group within those elements based on unit of account, which is a function of the types of contracts, the timing. I remember one of the key attributes of the timing is that in any bucket, there can never be two contracts or more contracts that are 1 year far apart. Anything more than 1 year far apart is not a qualified basis. And also on the basis of profitability, you also consider that. All of these are what you consider. And take note, similar to some limitations you have under IFRS 9 on reclassification of financial instruments, here is more even stringent that on no basis can you reclassify from one unit of account or quote to another. Okay, and therefore you won't be able to say something belongs to this quote and later on you are changing it to another quote. No, because at the inception of the contract, you have looked at various characteristics and features in order to arrive at the quote to which a particular contract belongs. And one of the primary factors you look at is the portfolio of the contract, which is the type of the contract. You look at the time, and also you look at profitability of contracts in order to look at that. Now, let's now look at like a decision tree that will guide us in having better understanding of this classification. Okay, can you look at the chart for us? Can you take us through the chart based on what we have discussed so far?
Okay, the diagram below illustrates what is at stake when setting levels of aggregation. Ultimately, an entity needs to strike a balance between the proposed granularity and its operational practicability. Level of aggregation, number one is operational impacts, financial impacts, and data insights.
Sorry?
Okay, sorry.
Okay, you can continue.
Okay, for operation impacts, it affects the number of groups for which CSM or loss components will need to be recorded and tracked. This could be burdensome. Systems and processes we need to cope. So for financial impact, there are three things. It affects the locked-in assumptions used for GMM, which affects the CSM. Secondly, splitting groups further to reflect different levels of profitability could lead to accelerated profit recognition in some cases. And lastly, less granular splits enables greater degree of offsetting within groups, which helps smooth results. And for data insights, having more granular information could aid insights into hidden trends, but care needed as could result in parallel shadow groups having to be tracked.
Yeah, what this simplifies is that there are 5 factors needed to be considered, which are based on 3 aggregate levels: operational impact, financial impact, and data insights. All of these are to be considered as a whole in order to determine the level of aggregation to which you create your quotes or your portfolio of contracts, because it has significant effect. And this also speaks to the fact that apart from doing this, you also need technology to aid the maintenance of this aggregation and the reporting, measurement, and accounting over the coverage period. All of those things are key things we are going to discuss when we get to final module. But in order to display knowledge of what we have done so far, what I will also do here is to more or less take us through models. I think I shared some models with you guys, and I'm going to share the model. I'm going to open the model again here for us to play with. Okay. Okay, now we are going to look at 4 scenarios, and we'll be fast about it because of our time. But again, the model will be made available to you guys, and the video will also be made available. Now, I want us to look at the first insight at the point of initial recognition. How do we measure our insurance contract liabilities based on the general measurement model or the building block approach as been discussed earlier? Okay, I want somebody to read the whole of this section up to the level we talked about the entity estimate the risk adjustment for non-financial use on initial recognition as 120 Naira. Can somebody read this for us and we'll move further from there?
Okay. Model 1, measurements on initial recognition. This scenario illustrates how an entity measures a group of insurance contracts on initial recognition that is onerous on initial recognition, and a group of insurance contracts that is not onerous on initial recognition. Assumptions. An entity issues 100 insurance contracts with a coverage period of 3 years. The coverage period starts when the insurance contracts are issued. It is assumed for simplicity that no contract will lapse before the end of the coverage period. The entity expects to receive premium of 900 Naira immediately after initial recognition. Therefore, the estimate of the present value of the future cash flow is 900 Naira. The entity estimates the annual cash outflow at the end of each year as follows. A, in example 1A, the annual future cash flow are 200 Naira, in bracket total of 600 Naira. The entity estimates the present value of the future cash flow to be 545 Naira using a discount rate of 5% a year that reflects the characteristics of those cash flow determined applying paragraph 36. B, in example 1B, the annual cash outflow are 400 Naira, total of 1,200 Naira. The entity estimates the present value of the future cash flows will be 1,089 Naira using a discount rate of 5% a year that reflects the characteristic of those cash flow determined applying paragraph 36. The entity estimates the risk adjustment for non-financial risk on initial recognition as 120 Naira. In the illustration, all other amounts are ignored for simplicity.
Okay, therefore, what we're going to do now is, if you understand the question, 100 contracts were written, and it's for an average period of 3 years, and the coverage period starts as the contract was issued. For simplicity, no contract we allowed before or after, and we are given the following. Therefore, what I would likely do is that I will populate the variables. What are the variables I have here? I have 5 variables here, which I'm populating. I have one-time insurance premium in year 0. I have my annual cash flow, which is the same in each year as a claim expected. I have coverage period of 3 years, discount rate of 5%, and risk adjustment of estimated at 120. Okay. Therefore, that is for A. I'm solving A first. Now, on that premise, I create my model. Okay. In my model here, what do I have? I have to link in my liability. Remember, the 900 you paid now is already at present value. It's not in future that will have discounted, which means the present worth of it is still 900. Whereas the 200 will be paid, estimated to be cash flow at the end of each year, being the claims made over 3 years. Therefore, what is the present value of that? Can you remember how to compute present value? So my own computation, I can show you here. What is it? My rate is 5%, which is my G31, 5%. Can you see it?
Yes.
My number of years is 3 years, G30. My payments, which is an outflow negative, 200 each year for 3 years. By the time I do that, I have no obligation in the future, which is 0. And the type of annuity is annuity at the end, which is 0. If it's in advance, it will have been 1. Okay, on that premise, that's how I got 554. At this point, I have estimate of the present value of future cash flow, subject to risk adjustment of 120. Therefore, my fulfillment cash flow, which is negative, which represents my profit, is 235. But based on the principle that I cannot recognize profit, therefore, what will I do? I'll have to more or less recognize a liability to zeroize that profit. And that liability, how do I recognize it? I use a function of the minimum. If you see the function I use, I said if my fulfillment cash flow is negative, return -1 times that amount, or return 0. If you remember the formula I showed you for CSM, -1 times the fulfillment cash flow, or 1, the maximum between -1 times the fulfillment cash flow and 0. Can you remember?
Yes.
Exactly. That is what I've done here. And you see it under illustration B, that is loss making, that it will not give me contractual margin because of its loss making. Now, my insurance contract asset or liability at initial recognition is 0, yeah? And that is that. Does that make sense?
Yes.
Okay, that is that. Now, let us now look at scenario B. What does scenario B say? Scenario B retains the same value. The only thing it changes is that you expect your payout not to be 200, but your payout should be 400. Now, if my payout is 400, what happens? What I'll just do is that I can more or less link the same thing I did, 900. Therefore, I find my present value. What is my present value for the 400 in 3 years? When your discount rate is 5%, it's 1089. How do I get it? See it here. The rate still remains at 5%. The number of years still remains at 3 years. But the difference is that your payout here, as estimated, is 400, which is like twice of what you had before, which is 400. And every other thing remains the same, which means this contract, from what you are seeing, is somewhat onerous. Even before considering the risk adjustment, it's already showing onerous. And on that basis, what happens is that I can copy this and look for it and see what happens. You find out that it's 0. Why is it 0? Because it's a loss, and a loss should be recognized what? Immediately. Am I making sense?
Yes.
Okay, therefore, on that premise, what has happened? Immediately I recognize a loss, it goes into part of my insurance service expense. as a loss for that year. Unlike the one that there's a profit, it doesn't go into my revenue because it will have to be recognized over the coverage period. Now, what can I deduce from here? What I've done also is that all of what I've done there, I've summarized it for your understanding to say, okay, let us look at what I've done. Let us first of all look at this. Let us look at immediately after the initial recognition, the entity received the premium of 900 and the kind amount of the group insurance contract will change. You know, before we have not received 900, we only did the price before the contract was undertaken. Now the contract has been undertaken and we have received the premium. Therefore, what do we do in this manner is for us to recognize that we have no present value of future cash flow again because we have collected that premium, which means that is zero. But we still have obligation for it, which is 545. We still have obligation for the risk factor, which is 120. And we also have the obligation for the CSM. And what is the CSM? If you remember, is 235, which means I link this to where it came from. Where did it come from? This 235. Can you see it?
Yes.
That's what I linked together, which means your insurance liability will be the entire 900. And for the other aspect, what will it be? Your insurance liability for the other aspect will be reduced or will be increased by the loss because it's onerous. Even though we collected 900, but it's increased to what? 1209, which means the 900 we collected plus the loss we have further assumed that we cannot run away from, which is what? 309. 309 plus 900 will give us what? 1,209. And all because we have recognized that loss immediately instead of defining the loss, which means our liability has been increased vehemently. Does that make sense? Now, if that is the case, let us see the summary of all what we have done. And I want somebody to read this. Can you read this out for us?
Okay, keynotes A to D. A, paragraph 32 requires.
Now, what is A? A is the fulfillment cash flow. How do I arrive at it? What is B? B is how I created my contractual service margin. What is C? C is the fact that I didn't create contractual service margin because of the loss-making or onerous contract. And what is D? D is my reconciliation I did here. Provide some clear guidance on the reconciliation I've done there. Okay, can you read this up for us?
Okay, A, paragraph 32 requires that the fulfillment cash flows comprise estimates of future cash flows adjusted to reflect the time value of money and the financial risk related to those future cash flows and the risk adjustment for non-financial risk. B, applying paragraph 38, the entity measures the contractual service margin on initial recognition of a group of insurance contracts at an amount that results in no income or expenses arising from the initial recognition of the fulfillment cash flows. Consequently, the contractual service margin equals 235 naira. C, applying paragraph 47, the entity concludes that these insurance contracts on initial recognition are onerous because the fulfillment cash flows on initial recognition are not on initial recognition are a net outflow. Applying paragraph 16A, the entity will group those contracts separately from contracts that are not onerous. The entity recognizes a loss in profit or loss for the net outflow, resulting in the carrying amount of the liability for the group being equal to the fulfillment cash flows and the contractual service margin of the group being zero. D, applying paragraph 32, the entity measures the group of insurance contracts on initial recognition at the total of the fulfillment cash flows and the contractual service margin.
Okay. Thank you very much. Now let's look at subsequent measurements of this. scenario 2. I want somebody to read this. Over to you.
Okay, model 2, subsequent measurements. The scenario illustrates how an entity subsequently measures a group of insurance contracts, including a situation when the group of insurance contracts becomes onerous after initial recognition. This example also illustrates the requirement that an entity discloses a reconciliation from the opening to the closing balances of each component of the liability for the group insurance contracts in paragraph 101. Assumptions. Scenario 2 uses the same facts pattern as scenario 1A on initial recognition. In addition, A, in year 1, all events occur as expected and the entity does not change any assumptions related to future periods. B, in year 1, the discount rate that reflects the characteristics of the cash flows of the group remains at 5% a year 5% a year at the end of each year. Those cash flows do not vary based on the returns on any underlying items. C, the risk adjustment for non-financial risk is recognized in profit or loss evenly in each year of coverage. And D, the expenses are expected to be paid immediately after they are incurred at the end of each year. After the end of year 2, the incurred expenses differ from those expected for the year. The entity also revises the fulfillment cash flows for year 3 as follows. A, in scenario 2A, there are favorable changes in fulfillment cash flows, and these changes increase the expected profitability of the group of insurance contracts. And B, in scenario 2B, there are unfavorable changes in fulfillment cash flows that exceed remaining contractual service margin, creating an onerous group of insurance contracts.
Okay, thank you very much. Now, this is a follow-up to the first scenario question. And what I'll do is to populate those variables once again. Okay. And it's based on 1A, which means it's based on this. Take notes. The subsequent examples are based on this. Okay. Now, it referenced 1A, and I've put back the variables there. Okay, but what I've changed is as follows, is that in year 1, all events occur as expected, which means there is no re-estimation of those current values, and the entity does not change any assumption related to future periods. Also, in year 1, the discount rate that reflects the characteristics of cash flow of the group remain at 5% a year at the end of each year, and that is not even expected to be changed because it's locked in on the premise that it's a GMM and it's not insurance contract with direct participation features that is eligible for VFA. Okay, that is that. The risk adjustment also is said to be evenly allocated, and it has not changed. And the expenses are expected to be paid immediately after they are incurred at the end of the year, which means all variables remain unchanged. Therefore, what will be the consequence of this? We'll look at the consequence year by year. Okay, now, you know, every year you estimate into the future by trying to determine what the position will be up to the end of the coverage period within the cohort. Okay, therefore, what will I do at this point in time is to reflect what I've done earlier as an inception. At the inception, my position was this. Okay, remember all what we've done. The premium you expected to have received on day 0, the present value of your cash outflow by way of claims, the risk adjustment, all of this remain the same as what we have in year 0. Okay, but in year 1, what has changed is that in year 1, my position has slightly changed. What has changed in year 1 is that I no longer expected to receive any premium, which means this is 0 because I've received one-time one lifetime premium.
Mhm.
Okay. But in year 2, I have 2 years to go for the claims, which means the claims I have is still going to be discounted at 5%. Now, number of periods to go is 2. Why is it 2? As at end of year 1, one claim will have been settled or will have moved to incurred. It's no longer within the remaining coverage. The remaining coverage is 2 years to go. And what I did was to say 3 years minus year 1 will give me 2 years to go. And I discounted my 200 cash flow. That means I have 2 cash flows expected to be paid in future, which is at the end of year 2 and at the end of year 3. This 2 cash flow, which is 200,000, will be discounted over 2 years, and there's no other future cash flows, and it is at the end of the year that the discounting takes place. Invariably, what I have is 372. Now, what has happened is that this risk adjustment has not changed from 120. But remember, I am to more or less charge it to profit or loss evenly over what? Over the coverage period, which is 3 years. And I'm in year 1. As at year 1, I will have charged 40. 120 in 3 years is 40 per year. 40 has already gone into profit or loss in that year, which means 80 remains a component of my fulfillment cash flow.
Mhm.
If you check this, what I've done here is in this formula, I'll just check the heading here. What I've done is N8. N8 is 120 minus G32. G32 is what? 3 years. Okay. No, sorry, G32 is 120 over G30. G30 is 3 years. 120 over 3 years is 40. I moved 40 from 120. It gave me the 80, which is yet to be recognized in the profit or loss. At the end of the day, I have 452 in year 1. At the end of year 1. At the end of year 2, what will it be? It will further reduce, assuming all other variables remain what? Unchanged. And what happened in that point is that I have no premium to collect again. And furthermore, 190 is the present value of the 200 that is the last payment to be made in year 3. If you check, 1 year to go, 5% discount, and 1 cash flow to go, which is 200. All other things remain what? The same. And that gave me 190. And remember, out of this 80, another 40 will go in year 2 into my expense. Remaining 40, which will be carried forward to the last year. Remember, 083 is this, my 80 minus the annual amortization, which is 40. That gives me the 40 balance. That shows for 230. By the time I get to year 3, there's no liability for remaining coverage, which is on expiries, because the coverage has expired. Everything is zero, all true. Even though I might have liability for incurred claims, but not liability for remaining coverage. We must take note of that. Now, the next thing we need to do is to show us how do we carry out reconciliation. How do we carry out what? Reconciliation. Let me start from estimate of present value of cash flows. This estimate of present value of cash flows, let me reduce it so that I can see it. Okay. Now, how do I arrive at this amount? Remember that as at the time we took over a new policy, this policy brought about estimate of present value of future cash flow of 355. Therefore, I had no balance at the beginning of the year because I've not underwritten any policy. As a result of new contracts, I have changes related to future service for the new contract, which will cost me, which has a liability of 355, which is the excess of what I've collected over what I'm to pay. Furthermore, I received cash of 900. If you remember, cash was later received, 900. Now, insurance finance expense is the unwinding of discounts. If you check here, it's 5% of the balance. Now, what is the balance we have as our CSM? You find out that our balance for the present value of outflow is 545. 5% of 545 will give you 27. Okay, changes related to current service, there's no changes because everything here was said as we expected it occurred. Therefore, there are no changes. Therefore, it's 0. Now, the cash outflow, how much we paid as at the end of year 1 when it crystallized, because we are told that it happened as expected at the same amount is 200. That is how we are able to reconcile our current amount of liability of 372. And in this 372, it has element of 235 in it, which is our contractual service margin. We're going to see that as we move on. Now for the risk adjustments for non-financial risk, let me reduce that so that you can see it clearly. What has happened? What has happened is that we start with an opening balance of 0. But during that year, we had 120 that came as a result of hello, can you guys hear me?
Yes.
Okay, I think I went off.
No, you didn't go off. You only kept quiet.
Okay, because it's showing network failure at my side here. That's why I thought I went off. Okay, let me continue from where I stopped here. I said the risk adjustment, we had 0 balance, but as a result of a new contract, 120 was recognized. This 120, can you remember? That came in as our risk adjustment. And thereafter, there was no cash inflow related to that. Insurance finance expense, you read it in comment C, why this is not affected or affected by that. And 40 was amortized. If you remember the 40, remember, we expected that the risk adjustment need to be evenly spread over the coverage period. The 120 divided by 3 years, the 40 is the 40 that we took away from 120 that gave this 80 balance. Okay, and which shows that 80 is the balance you have, which you can see here. Do you get what I'm saying now? Okay, this 372 is what you can see here. 80 is what you can see here. Now, contractual service margin, you find out that it is 0. And what we are going to see is that how do we now recognize contractual service margin? You are going to recognize it by, first of all, recognizing the contractual service margin created by that new contract, which is 235. Remember, this 235 is coming from this contractual service margin here. No effect of cash inflows, but in that year, we need to unwind the discounts and settle with it, which is the 5%. 5% of our opening balance, 235. That gives 12, which means our new balance is 235 plus 12, which is 247. And this 247 is for how many years? 3 years. Now, there are 2 approaches here. The first approach, which is what I've adopted, is that I've assumed that the coverage units are evenly distributed. And on that basis, I just divide the sum of 247 by 3. And that is how I'm able to produce 82. If you check, 235 plus 12 divided by 3, which is G30, is what produces that 82, which is what I amortize. Alternative to that 82 is that you can do the annuity. Okay, the annuity is to say this 235 is a present value of an annuity that will be paid equally, over time. And what is that? What is that is that I'm going to now say present value. I use present value, and I can open the function. When I open the function, I need the rate. What is the rate? The rate is 5%. What is the number of period? 3 years. What is the payment? No, sorry, I'm using present value. I'm supposed to use the payment function. Sorry, let me use the payment function. What is the rate? 5%. Number of period, 3 years. What is the present value? The present value is the 235, which I have here. 235, I might even pick it from here. What is the future value? The future value is 0 because by the time I only paid it over 3 years, it will be 0. And what is the type of annuity? It's annuity, ordinary annuity, which is as at the end of the year. The argument is false, which is 0. Sorry, 0. On that basis, what do I get? I get 86. Which means the difference between this and this method is that this 86 will be equal over 3 years, assuming nothing has changed in the assumption. But even if nothing has changed in the assumption for this 82, in the next year, it will not be 82 because the balance of 165 will have been affected by accretion again. And which means 165 next year, affected by accretion of 5%, will be increased by this, which then means that 165 plus this accretion will give me a new value of 173. If I now divide 173 by the remaining useful life, which is 2 years to go, it will give me 86. Now, if I take 86 out of 173, that will be the balance I carry forward to the third year, which is 86. And that 86 also will have its own accretion of 5%. Once I do that, it gives me 432. By the time I sum it up together, it gives me the balance that is available to be recognized in year 3, which means over time, I've recognized 82, 86, and 89. 82, 86, and 91 will give me 256. And 862, 86.42 times 3 will also give me something close to it, 259. Can you see it?
Yes, sir.
Yeah, which means that any of the methodology is applicable. But the first one I consider is on the premise that the coverage units are equal. But on the second one, is based on annuity factor. You understand? But the beauty of it is that anything you are doing must be consistently applied. Does that make sense?
Yes.
Okay. Now, what are the information that summarizes all what we've done? Let me eat this. So that you can see the whole picture. Okay. Now, what is the summary of all of the points I've made here? I want somebody to read it out. Can somebody read this out?
Okay, I will. A, applying paragraph 44A, the entity adjusts the contractual service margin of the group of contracts with any new contracts added to the group. B, in this example, insurance finance expenses of 27 naira are calculated by multiplying 545 naira, the difference between the estimates of the present value of the future cash flow at initial recognition of 355 naira, and the cash flow of 900 naira received at the end of year one by the current discount rate of 5% determined by applying paragraph 36 and paragraph 72A. C, applying paragraph 81, the entity chooses not to disaggregate the change in the risk adjustment for non-financial risk between the insurance service results and insurance finance income or expenses. Therefore, the entity presents the entire change in the risk adjustment for non-financial risk as part of the insurance service results in the statement of profit or loss. D, applying paragraph 44B and paragraph 72B, the entity calculates interest accreted on the carrying amount of the contractual service margin of 12 naira by multiplying the opening balance of 235 naira by the discount rate of 5%. That rate is applicable to nominal cash flows that do not vary based on the returns on any underlying items determined on initial recognition of the group insurance contracts. Applying paragraph 44E and B119, the entity recognizes in profit or loss in each period an amount of the contractual service margin for the group of insurance contracts to reflect the services provided under the group of insurance contracts in that period. The amount is determined by identifying the coverage units in the group. These coverage units reflect the quantity of benefits provided under each contract in the group and its expected coverage duration. The entity allocates the contractual service margin at the end of the period before recognizing any amount in profit or loss, equally to each coverage unit provided in the current period and expected to be provided in the future, and recognizes in profit or loss the amount allocated to the coverage units provided in the period. In this example, the service provided in each period for the group of contracts is the same because all contracts are expected to provide the same amount of benefits for all three periods of coverage. Consequently, the amount of the contractual service margin recognized in profit or loss in the period of 82 naira is 247, which is 235 plus 12 naira, divided by 3 periods of coverage. The entity could achieve the objective of the recognition of the contractual service margin on the basis of the coverage units using a different pattern. For example, the entity could allocate equally in each period the contractual service margin, including the total interest expected to be accreted over the coverage period. In this example, the allocation pattern using this method would equal 86 naira in each period, calculated as 86, which is 235 multiplied by 1.05 and divided by 1 plus into brackets 1 divided by 1.05 times 1 plus 1 divided by 1.05 times 2. Instead of the increasing pattern of 82 in year 1 and 86 in year 2 and 91 in year 3. You're muted, sir. You are muted, sir.
Okay, thank you for that. And can you hear me?
Yes, sir.
Okay, sorry, I think my network is unstable. Let me check which of the network. Okay, let me switch to the former one. Okay. Let me make clarity of what happened here. This is raised to power. And let me try to do that for you down here. This is raised to power. Superscript. So that I can see clearly mathematically. Okay. Now can you see it clearly mathematically?
Yes.
Huh?
Yes.
Okay. Let me do this also for you to see clearly. Even though mathematically that I'm doing now is wrong, but it will make it clear for you to see. Now, this is what I did by using PMT function, payment function on Excel, which we got the same results. Okay. Now, let's move to scenario 2A. Remember, you read something here that at the end of the year 2, the incurred expenses differ from those expected for that year, and the entity also revises the fulfillment cash flow for year 3 as follows. A, in scenario 2A, there are favorable changes in fulfillment cash flow, and these changes increase the expected profitability of the group of insurance contracts. That 2A is what we want to expatiate on. We didn't do anything on it here. We are now going to do something on it here because we are now filled with additional information. Now, over to you.
Okay. This scenario illustrates how an entity subsequently measures a group of insurance contracts, including a solution when the group of insurance contracts become onerous after initial recognition. This example also illustrates the requirement that an entity discloses a reconciliation from the opening to the closing balances of each component of the liability for the group of insurance contracts in paragraph 101. Assumptions. At the end of year 2, the incurred expenses differ from those expected for that year. The entity also revises the fulfillment cash flows for year 3 as follows. In scenario 2A, there are favorable changes in fulfillment cash flows, and these changes increase the expected profitability of the group of insurance contracts. And at the end of year 2, the following events occur. A, the actual claim of 150 naira are 50 naira. Are 50 naira lower than originally expected for this period. B, the entity revises the estimates of future cash outflows for year 3 and expects to pay 140 naira instead of 200 naira. The present value is 133 naira instead of 191 naira. A decrease in the present value of 58 naira. And C, the entity revises the risk adjustment for non-financial risk related to estimates of future cash flows to 30 naira instead of the initial estimated 40 naira.
Now, let me explain what has happened here. The actual claim was 150, which means you expected to be 200 in year 1, but it came to 150. You've gained, Abby. That will likely increase a component of your activity, and you're going to see that. 2, the entity revised the future estimates that going forward is now 140, not 200. And that will limit your liability by increasing your CSM, which is also it will limit your payout by increasing your profit, which increases your CSM as a liability. And in that manner, the present value that is supposed to recognize at 191 is now being recognized at 133 because of the PV of 140 in a year's time and the PV of 200 in a year's time at 58 naira apart. You are going to see that. Also, we had savings from the cash flow. Initially, we estimated 120, which is 40 per year. But eventually, year 1 and year 2 were 40-40, but year 3, we expect it to be 30, which means we have saved 10. Which means overall it's 110, no longer 120, because it is 40 in year 1, 40 in year 2, and likely to be 30 in year 3. Therefore, on that premise, I populate all of this. What it means is that what I have before has not changed. Remember this we have before from our first 2 scenarios. Now, as at end of year 2, the actual event of year 2 has made us to re-estimate our future assumptions. One of those changes is 1, we re-estimate it was 80 we estimated, but at the end of the year, we have 30 as the actual. Okay, actual claim in year 2 was 150. It's not applicable for year 0, even though we estimated 200, but it was 150. And on that basis, we re-estimated future cash flow at 140. Fortunately, our estimation at 140 is exactly 140 we actually paid out as insurance claim in year 3. On that premise, we are now told to say, okay, we already know our year 0 and year 1 before now. Based on this new information, what will have been our position in year 2 and year 3? You find out that our position in year 1 and year 0 and year 1 will not change, except for year 2 and year 3 to reflect the favorable changes in the condition. And we are going to see that as we move forward. Okay, see what has happened. You observe that year 1 to year 2 has not changed. Let me take my pen. My position in year 1 and year 2. Let me try and clean it up. I think I didn't draw it well. Okay. Let me draw it well. This position is exactly in tandem with what we had before, because those estimates and the actual never change. If you remember, this is it here. But this is where the changes come from. Year 2 and year 3. And let's see what happens. In year 2, instead of estimating on the basis of 200, my estimate changed to the basis of 140 because of the revision that was made. And that's why it's showing 133. But if I base this 140 on 200, it will have given me 190. Okay. The difference between 190 and 133 is that 58 that they try to explain here. Can you see it here? Mm-hmm. Okay. Now, also, instead of having 40, I've revised this downwards because of one thing to what? To 30, because 80 has already gone. 40 in year 1, 40 in year 2, and supposed to be 40 in year 3, but the actual position of year 3 came down to 30. And that is the position here. And on that premise, this is my fulfillment cash flow in year 2. In year 3, there's no longer liability because the coverage period has expired. Therefore, if there is peradventure any liability, it will be liability for incurred claims, not liability for remaining coverage. and which is the position here. Now, what now happens with respect to our reconciliation? Now, remember, these are the opening balances or the closing balances in year 1, 617. If you want to go back, can you see 372, 18, 165, and 617?
Yes.
That's our opening in year 2. Now, our reconciliation for year 2 is as follows. For the estimated present value of future cash flows, our reconciliation of arriving at 133 is what we've done here. Now, there is no new contract. 2, there is no new cash inflow. 3, we unwind the discount, which is 5%. 5% on the opening balance, which is 372. If you remember, can you see 372, yes, which is the same 372 here? Now, the changes to future services. Remember, the difference between 133, which was based on 140, and 190, which was based on 200, is this 57 that reduces your body. Can you remember?
Yes, sir.
There's a lot of changes to future services. And also, what is the changes to current service? Current year, as at last year, you estimated 200, but actual amount you paid for insurance in year 2 is what? 150. And that is what brought about the savings of 50, which means the changes here is as a result of reduction of 200 to 150, which has brought a benefit to you. And that's how we reconcile that. Also, how do we reconcile the risk adjustment? The risk adjustment is as follows also. Now, there's no impact of new contract, neither is there impact of cash inflows. And likewise, the same decision we took about the insurance finance expense with respect to unwinding was also not considered here because it does not affect risk adjustments in this case. Now you can see that there's a change to effect of future service because of 30 that we estimated for year 3 against 40. And that brought about savings of 10. And we still add 40 for the current year, which is not a problem. Okay. Now, at the end of the day, what we have is this 30. We have been able to reconcile the 30. Okay. Now, the next thing we need to do is to look at the contractual service margin. It was 165 before, but what are we recognizing for the current period based on the position we have at hand? What's the position? There is nothing arising from new contracts. There's no impact of cash inflow, but unwinding the discount, if you remember, is 5% of the opening balance. Okay, and now there's a changes related to current service, which is the sum of changes attributed to present value of cash flow and that of risk adjustment, which will impact your contractual service margin because it's either it's going to increase your profit or subsume your profit.
Yeah, but this time it's increasing the profits.
Yes, because all the conditions are favorable to you. If you remember the favorable position we talked about.
Yes.
Now, at the end of the day, your contractual service margin has become 165 plus 8 plus 67, which is now 240. And there are 2 years to go. On the premise of what we did earlier, by assuming that the coverage units are evenly distributed, it means 240 in 2 years is 120. We are amortizing as insurance revenue, which is 120. And 120 is what you can see here. It is 165 plus new contract plus 8 plus 67 divided by 2. And that's how we got that 120, leaving a balance of 120. You can see now.
Yes, sir.
And the sum of all of this is what constitutes your insurance liability, which means our insurance liability has reduced from 617 to 283 in that year. Does that make sense?
Yes, sir.
Now, let us see the position in year 3, because we are given the actual position in year 3. In year 3, also, we come back
to say that at the end of year 3, the coverage period ends. So the remaining contractual service margin is recognized in profit or loss. In these examples, all claims are paid when incurred. Therefore, the remaining obligation is extinguished when the revised cash flow outflow are paid at the end of year 3. At the end of year 3, applying paragraph B96 to B97, the entity analyzes the source of changes in the fulfillment cash flow during the year to decide whether each change adjusts the contractual margin. Using this information, if a possible format, let me enlarge that. Okay, a possible format of the reconciliation of the insurance contract liability required by paragraph 101 is as follows. Now, remember, this is the balance we have in year 2, which we open with in year 3. Now, in year 3, based on similar changes that has happened, based on actual, what will be our position? Our position is as follows. Now, look at it. I'll do it at once. These are our position. One, we only unwind this 133 with a discount of 5%. Remember the 5% here? Now, at the end of the day, it's agreed to the actual cash outflow we are making, which means because our estimation last year between year 2 and year 3 has not changed with the actual. That's how we zeroize it. Now, the risk adjustment also has not changed to the actual. The 30 goes off. And also their contractual margin was 120. We accrued interest, which is 5% of 120, which gives us 6. And everything is now recognized in profit or loss because there's no longer coverage units available after the end of year 3. And that is how our liability comes from 283 to 0 after the end of the coverage. Remember, the whole of this liability is liability for the remaining coverage.
Yes.
And there's no coverage after year 3 because all has expired. Now, what is the impact on our financial position and on our income statement? The impact is very simple. Okay, the cash flow impact is as straightforward as what we have here. And therefore, the cash flow impact is that in year 1, you have 900, of which as at the end of year 1, you have paid out 200. That gives you 700 left. In year 2, you have paid 150 out of 700. It gives you 550 left. In year 3, you have paid 140. It gave you 140, 410 left. Now for insurance contract liability, as most especially this with liability for unexpired risk, or let me call it for remaining coverage.
Yeah.
And why it's only for remaining coverage period is because we have assumed in the information provided that claims are paid as at when due. Nothing is carried forward to next year. Therefore, there's no liability for incurred claims because it has been extinguished. Therefore, this 617 came from year 1, 283 came from year 2, and 0 came from year 3. Now, retained earnings will come back to that. For income statement, this is our insurance revenue, insurance service revenue, which comes with changes in related current service, 122 in year 1, 210 in year 2, and 156 in year 3. How do we arrive at it? You can come here to see what it is. Now, you will see that this 22 is our scenario 2. Okay. I'll link it for you now. You see it. Can you see it here? Changes related to current service.
Okay.
where we are accounting in year 2 and in year 1, sorry, this was year 1. Okay. And the one for year 2, we have it here, which is changes to current service. Anything to future service is adjusted against contract service margin. Okay, and year 3 is 156, which is this. Now, insurance finance cost for year 1, we can trace it back to year 1. That is 39. Can you see it here?
Yep.
Okay. In year 2, you can see year 2 from what it is here. Insurance finance expense. Year 3, you can see it here 13. And that is that. Okay. Therefore, let me show you the summaries of notes that are provided as a guide for further understanding of the position I've taken. Now, somebody should read this.
Okay, keynotes. A, for the method of calculation, see year 1. B, applying paragraph 44C, the entity adjusts the contractual service margin of the group of insurance contracts for changes in fulfillment cash flows relating to future service. Applying paragraph B96, the entity adjusts the contractual cash margin to, the entity adjusts the contractual service margin for changes in estimates of the present value of future cash flows measured at the discount rate determined on initial recognition of the group of insurance contracts of 58 Naira and changes in the risk adjustments for non-financial risks that relate to future service of 10 Naira. C, applying paragraph B97C, the entity does not adjust the contractual service margin for the experience adjustment of 50 Naira, defined as difference between the estimates at the beginning of the period of insurance service expenses expected to be incurred in the period of 200 Naira and the actual insurance service expenses incurred in the period of 150 Naira. Applying paragraph 104, the entity classifies both changes as related to current service. D, in year 1, the amount of cash of 700 Naira, of minus 700 Naira equals the receipt of premiums of minus 900 and the payment of claims of 200 Naira. There are additional payments of claims, that is 150 Naira in year 2 and 140 Naira in year 3. For simplicity, there is no interest accreted on the cash account. E, the presentation illustrates the amount recognized in the statement of profit or loss.
Yeah. Thank you very much. Now we'll look at the final scenario and the final model, which is model 4. Model 4 is similar to model 3, but the position of model 3, if you go back to model 2 we had under scenario 2, they said at the end of year 2, the incurred expense differ from those expected that year. The entity also revised the fulfillment cash flow for the year as follows. B aspect of it says, in scenario 2B, there were unfavorable changes, whereas in the A, there were favorable changes. Now, there is unfavorable. Unfavorable means it could also create an onerous contract or a reduced amount of contractual service margin. Therefore, we'll now go back to model 4, where we'll have additional information that demonstrated that unfavorable condition. Can somebody read this up for me?
Okay. I should go straight to the assumptions, right?
Yes.
Okay. At the end of year 2, the following events occur. The actual claims of 400 naira and 200 naira higher than originally expected in this period. The entity revises the estimates of future cash outflows for year 3 to 450 naira instead of 200 naira, an increase in present value of 238 naira. The entity also revises the risk adjustment for non-financial risks related to those future cash flows to 88 naira at the end of year 2. That is 48 naira higher than the originally expected 40 naira.
Okay, thank you very much. Now, see what has happened in this case. As opposed to favorable condition, we now have unfavorable condition. And these are the variables that are attributed to the unfavorable condition. One, 200 estimate was changed to 450 because we experienced double of our estimate as our actual claim in year 2. Likewise, we also revised upward the risk adjustment away from 40 by additional 48 to 88 for the last year, which is year 3. Therefore, what does this bring to the table? Okay, similar to what we've done before, there's nothing different to show up the position that nothing changed in year 1, in year 0 to year 1, but we start to experience the changes in year 2. Now, for example, you find out that measuring this was based on 450 instead of 200. And on 450, we are having measure of 429. But if it's 200, what do we have? We'll have had 190. The difference between that will have accounted for changes in future services that we are going to take as an adjustment against our CSM. Okay, and 88 also, instead of having 40 left, we have 88 because there's an increase of 48 as demonstrated from the new estimation here.
Yes.
48 higher than what it is. Now, that is the position that has shown. Now, to reconcile this position, we also go back and compute all our accretion, amortization, and any subsequent changes that may affect current and future periods. And doing that, as you remember, unwinding of discount element inherent in the present value of the cash flow is 5% of the outstanding balance brought forward, which is 372. Okay, as usual, let me try and okay, now 238 was the changes that we experienced between 249 and 190. And that's what we have recognized here as the changes related to future service, which is unfavorable because it's increasing our liability. Likewise, changes to current service, which is 200, and our outflow of 400. Everything increased, these are cash flows to 429. Okay, the risk adjustment increased by 48 after amortizing 40 to reflect 88. And that's why you find out here, you have 429, and you also have 88. 429, 88. Now, on our contractual service margin, you find out that it is 0. Why is it 0? It's because at the end of the day, we add accretion, which is 5% of our opening balance. But unfortunately, the changes in future service has eroded the all of our contractual service margin, which means this contract, this insurance business prior to now is profitable, but over time, it became onerous. Therefore, the entire onerous position was 48 and 238. 48 and 238 is 286. But we only have 165 and 8, which is 173 available. Which then means that in that manner, we write off the entire profit, which is 173. And we still have loss above that 173 to the tune of 113, that will immediately be written off into profit or loss as a loss from the onerous contract, which means the total loss is 233, what's it called? The total loss is 286, of which we only have 173 balance in the CSM, which cannot absorb all the loss. Therefore, we write the CSM to 0, and the excess over the CSM becomes loss onerous contract that is immediately recognized in profit or loss, which is this 113. The changes related to current service is 160. Okay, and the cash outflow was 400. That is what increased our liability to 515, reduced it to 515 from 617, as opposed to the scenario we had before that reduced from 617 to 283. This has not reduced substantially because it has even wiped out our CSM, and it has also more or less increased our losses from the insurance business. Now let's see what happened in year 3. What is the position in year 3? We bring the balance down from year 2 to year 3. You can see it's 17. And what is our position in year 3 is for us to carry out all necessary measurement that is required. And what is it in this slide? You find out that we carry out an accretion of that 5% on the opening balance. And since what we estimated applies, actually, therefore it zeroizes it. Likewise for risk adjustments. Now there's nothing to accrue on contract service management because it has been zeroized. At the end of the day, our position became a 0 based on the actual position being in tandem with what we re-estimated or re-evaluated at the end of year 2. Now, finally, what is the position with respect to cash flows? The position with respect to cash flows is as follows. Okay, you can find out that our cash position was 900. After paying out 200 in year 1, it remains 700. In year 2, our payout doubled to 400, which reduced 700 to 300. And in year 3, we paid out 150. Sorry, we paid out 450, which gave us a cash position that becomes more or less an overdraft. Let me put a position there. Bank overdraft. Which is a positive position there. Let me put it in red. And put this in red. Okay, which means we've overdrawn position because we enter into an onerous contract. Okay, now our liabilities are from what we have in year 1. If you remember year 1. If you come back to year 1, that's 617. In year 2, 517, and in year 3 is 0. Now, changes in relation to that, remember, we term that as our insurance service revenue. Okay, remember the 122 which I showed you earlier, which came from year 1? Is still this 122?
Yep.
Okay. 160 arose from the loss. You can see that here, which is more or less a loss because we have much more of expense than that, and therefore I'll put it here, or expense. I'll put expense in red and negative. okay, and 88 in year 3. Now, at the end of the day, the entire contract came at a marginal profit of, or revenue of 50. Now, insurance finance, you can find it out here in year 1, which you can trace to year 1. You can find it, which is 39. Come back here, year 2, you can trace it here, 27. And year 3, you can trace it here, 21. Now, what is new there is the loss arising from onerous contract. If you remember, the loss here, which is in excess of the CSM, is taken directly to profit or loss, which you can see here. Can you see it? Loss on onerous contract, 113, which shows our net position of a loss of 150, which is supported by our cash flow deficit of 150 over the life of our contract. And on that premise, the summaries I provided is as follows. Can somebody read it out?
Okay, the summary, the keynotes. For the method of calculation, see year 1. B, applying paragraph 44C, the entity adjusts the contractual service margin for the changes in the fulfillment cash flows relating to future service, except to the extent that such increases in the fulfillment cash flows exceed the carrying amount of the contractual service margin, giving rise to a loss. Applying paragraph 48, the entity recognizes this loss in profit or loss. Consequently, the entity accounts for the changes in the fulfillment cash flows related to future service of 286 naira. Estimates of the present value of the future cash outflow of 238 naira plus a change in the risk adjustment for non-financial risk of 48 naira as follows. 1, the contractual service margin is adjusted by 173 naira, which reduces the contractual service margin to 0. And 2, the remaining change in the fulfillment cash flows of 113 naira is recognized in profit or loss. C, applying paragraph 44E, the entity does not recognize any contractual service margin in profit or loss for the year because the remaining balance of the contractual service margin before any allocation equals 0. That is 0 equals to 165 plus 8 naira minus 173. D, as calculated under scenario 2.
Thank you very much. Thank you very much. Therefore, we'll move to wrap it up because we've done substantial job. And what we just want to ask ourselves is transition to IFRS 17. What are the requirements? What are the disclosures required? Okay, I hope Tosi is there. Okay, is Mr. Uche there?
Yes, I'm here.
Is Mr. Uche there? As a regulator, I want Mr. Uche to more or less take over this session. Okay, but since it's not there, Tosi, I want you to take this session to describe some of those things we've mentioned and discussion we've had. What are the transition requirements and the 3 approaches towards adoption of IFRS 17, and which one will be more favorable in the context of organization.
Okay, so you want me to read it, right?
Yes, it's a decision requirement.
Okay, so transition to IFRS 17, requirements and disclosures. Transition requirements. Number 1, an entity shall apply the standard retrospectively unless impracticable, in which case entities have the option of using either modified retrospective approach or the fair value approach. Number 2, at the date of initial application of the standard, those entities already applying IFRS 9 may retrospectively redesignate and reclassify financial assets held in respect of activities connected with contracts within the scope of the standard. There are 3 accounting options available on transition to IFRS 17. Option A, insurers should process their data from policy inception to implementation date, suing the full rules as if they had reported at the time. This is called full retrospective approach. Option B, the modified retrospective approach can be adopted where certain assumptions can be made and where the full retrospective approach is considered impracticable. Option C, there is the fair value approach, where the initial recognition at the transition date is based on the fair value of the contract. You are mute, sir.
In Nigerian context, any organization, insurance company in Nigeria can adopt the full retrospective approach. I doubt it. Okay, but Nigerian insurance companies are favorably disposed to modify retrospective approach at fair value. But because of limitation of data, historical data, stratification in terms of cohort and all sorts of things, I felt that most insurance companies will go for fair value approach, where actually just try to look at the data, try to fair value them, try to more or less stratify them at the point of adoption and going forward rather than looking backward. And in that case, come up with a value that over time will correct itself and normalize. You understand? But option A in Nigeria, I don't think is practicable, but it falls within option B and option C. Now let's go deeper to option A, B, and C. Can you further more on them? Are you there to see?
I mean,
you are still muted.
Okay. Okay, I'm here now. Option A. So I've read that insurers should process their data. I've read that from policy inception to the implementation date. Okay. Insurers should process their data from policy inception to the implementation date, so as if they had reported at the time. This is called full retrospective approach. Number one, at transition, each group of insurance contracts, in brackets, unit of account, should be reported as the sum of the fulfillment cash flow, including onerous contract liability if required, risk adjustment, and CSM. Current CSM equals initial CSM at inception, and adjusting it to reflect the experience until the transition date at locked-in rates. Capture the cumulative amount of insurance finance income or expenses recognized in other comprehensive income at transition.
Okay, let's look at the modified retrospective approach.
Okay, the modified retrospective approach can be adopted where certain assumptions can be made and where full retrospective approach is considered impractical. Number one, an approximation of the full retrospective approach without undue cost or efforts. Number two, each simplification below can be adopted only if there are insufficient data. Grouping of contracts, for example, more than one underwriting year. Use of yield curve, e.g., discount rate specified as of transition instead of at inception of contract. Cash flows estimated at inception. FCF at transition adjusted by cash flows known to have occurred since inception. Risk adjustment estimated at inception equals RA at transition, that's risk adjustment at transition, adjusted by expected release based on other similar contracts. Approach to capture cumulative impact in other comprehensive income at transition. Then the fair value approach now. Okay, there is the fair value approach where the initial recognition at transition date is based on the fair value of the contract. Number one, IFRS 13 market participant price to transfer the asset or liability equals fair value at transition. Fulfillment cash flow and risk adjustment liability are to be measured based on IFRS 17 measurement approach at transition date. CSM balance or loss component at transition is set at the difference between 1 and 2 above. Fair value could be derived by adjusting IFRS 17 fulfillment and risk adjustment liabilities to reflect a market participant viewpoint and include other non-attributed expenses that the market participant will expect to be covered by the premium, not required to separate contract into underwriting here. I think you should help me explain this number 5. I don't get it.
Okay, now let's pick it one by one. Remember, fair value is in IFRS 13.
Yes.
Okay, and based on that, market participant price is what is considered as the fair value at transition date, which means once they measure it at fair value based on fulfillment value under the current value approach, the fulfillment cash flow and risk adjustment liability are to be measured based on IFRS 17 measurement approach at transition dates, but the cash flow and other aspects of it also will be affected by IFRS 13 measurement. Now the CSM balance in that situation, if any, or the loss component at transition is set as a difference between 1 and 2 above, which means what your actuary has fair value based on IFRS 13 and what they've also valued based on requirement of GMM under IFRS 17. The difference of it will be deemed at transition date to give rise to either loss, which make the contract onerous and will be written off to profit or loss through retained earnings. That is at transition date. Or it gives rise to profit, which will be nullified by the creation of CSM and will be recognized as insurance contract liability for the remaining coverage as at that point in time. And going forward, other things will be normalized in tandem with the GMM methodology. Now, therefore, we now say that the fair value could be derived by adjusting IFRS 17 fulfillment and risk adjustment liability to reflect market participant viewpoints, which is market participant viewpoint is the perspective of IFRS 13. Okay, and take notes. It is also not necessarily required to separate contract into underwriting year because it's historical in nature. But going forward, we have said the court, the timing factor must be taken into consideration, which must not be 1 year apart for whatever reason it is. But that is not necessarily considered because these are historical transactions that might not be practicable to separate based on the limitation of applying full retrospection or modified retrospection. Are you getting it, sir?
Yes, yes, sir.
Now let's look at the timeline. Now, the timeline is this. The timeline has been shifted technically to 2013, to 2023. But again, the comparative period has begun from 2022, which then implies that insurance company must start to ensure, because they will need the comparative data against 2023 financial statement, quarterly account before even the end of the year, they must start to, from January 2022, they must start to reflect what the new model is for the sole purpose of comparative analysis and for experience data. And that is what this timeline is talking about. And in addition to that timeline, you can find out that certain things ought to have been in place by now. This is where we are now, 2021 end. They're supposed to be test running data, but I don't think most of us are probably at planning stage, if not at impact assessment and business case. These are the process towards transition. And by 2022, you should have handed over an embedded system, okay, which I don't think we have gotten into. The earliest organization in Nigeria that will have complied probably will be at the build and implement, but not necessarily test and dry run. Okay. Now, what are the other issues we have? Can somebody mute there? There's echo. Okay, these are other issues that are there. Implication of IFRS 17 for adoption to business. Now, to apply the new standard, many companies will need to have more information at their disposal than they currently possess. Two, in addition, adopting standard may require significant resources and improvement to the company's business processes and IT system. Three, new requirements are now in place, particularly in terms of disclosure requirements. Honest contracts will be immediately recognized in profit or loss statements. Also, the complexities and the sophistication of actuarial model will increase significantly after IFRS 17 adoption, while existing model will require serious revision. Also, the selected transition method will impact the cost of adoption and financial performance of the company. That is why I felt that Nigerian companies should go much more for the third version or approach, which is the fair value, or at least with the modified full retrospection, but not full. Okay, and lastly, a special focus is needed on interdepartmental collaboration, particularly between finance and actuarial functions. Now, what are the requirements you need? Key requirements must have adopted and delivered by 1st of January 2022 because of your comparative position. To create the opening balance sheet at transition date, your transition date is 1st of January 2022, which will be your earliest reporting date for the comparative period in which you have adopted IFRS 17. Okay, to create the opening balance at transition date and comparative dates, insurance company will need to look back to gather data for some or many years. Impact of transition is to be recognized in the opening retained earnings or equity, as the case may be. Okay, these are other issues that surround the actuary, because they are going to play a pivotal role in the measurement of the insurance liability through various models. There will be technical consideration, there will be operational consideration, and there will be other consideration, as the case may be. The technical consideration will be the measurement model choice between PAA and BBA, risk adjustment approach, level of aggregation and onerous contract, and understanding the impact of profitability. Also operationally, working day timetable impacts, changes in roles, KPI, and management information requirements, interactions between pricing, reserving, and capital will also be considered. Okay, and furthermore, within the actuary context, the following are key, which will play impact in the measurement of the insurance liability. What are they? Increased volatility in results, metrics for performance management, more detailed disclosures, consistency in regulatory messaging, preparing investors for change, managing the message to market, technical understanding, data requirement, new processes and systems, calculations and reconciliations. All of this will be needed extensively. And this position is as adopted from the staple in actuarial society, okay, which they've gone beyond necessary to identify certain things. Now, what are the summaries of the benefit of IFRS 17? One, it increases global comparability for the first time within insurance business, relevant and updated measurement of liabilities, financial risk and economic mismatch reviewed, source of earnings approach to performance, value of new business integrated with the new accounting, and disclosure and greater transparency as depicted, and intuitive accounting that will be much more understandable by the users of financial reports. Furthermore, disclosure requirements. Disclosure requirement can be subgrouped into three categories: significant judgments, nature and extent of risk, and the amount involved. Under the significant judgment, process to estimate input to method, effect of changes in method and input, confidence level for determining the risk adjustment, and yield curve used to discount cash flows must be disclosed. Under the nature and extent of risk, you must disclose the nature and extent of the risk. You must disclose insurance risk on gross and net basis. You must disclose the concentration of insurance risk and claim development through your matrices. And you also quantify your quantitative disclosure about non-insurance risk must also be disclosed, especially risks that are financial risk as a result of the deposit component in an insurance contract. Finally, you disclose in relative to amounts. One, details roll forward schedules and reconciliations, reconciliation of sources of profits. You disclose contract written in the period, and you also disclose relationship interest and investment returns. All of these are critical disclosure requirements. And on this premise, if there are any other practical questions for us to have a closure on this extensive discussion over the past 7 or 8 hours. Any question, contribution, conclusion for us to have a wrap-up and the closure?
Okay, the only thing I will just say at this point is just to appreciate you for this extensive delivery of IFRS 17. Before now, I've been just going here and there, trying to read one article or the other, one journal or the other, but the thing did not sink in as I've had it today. So this is just like, taking me from wherever I am to the highest standard, and I really appreciate this, and I've been looking up to it. So now I feel more confident, to engage in discussion and to proffer solution to any problems relating to recognition of insurance contracts. Yeah, so this is just to appreciate your efforts, and I believe I will still need to go over it again, to like internalize it more and assimilate the detailed information in this video. So thank you very much. I really appreciate it. God bless.
Okay, thank you for the comments. Any other question before we call it a day?
Okay, not much of a question, but comment. I would like to say that this is very interesting, and I want to really appreciate and thank you for your time and for the presentation. In fact, it met and exceed my expectation. I could say reasonably, out of the 100% knowledge to be derived from all of these things, I've captured at least not less than 45–50%. And I believe that the rest of the remaining percentage, so that could make me very solid and, be very confident in being able to help companies implement IFRS 17, just to ensure that I go back to everything that we have learned, I keep researching more about it and keep adding knowledge wherever I can add knowledge and in practical terms towards this. But you've provided a very solid background, a very solid foundation needed for us to move ahead and forge ahead to becoming a very good professional in this area. Thank you very much, Mr. Muiwa. God bless you so much. And thank you all the members of the team that participated very well. Shegun, your questions sometimes is very tasking and it's very helpful and very impactful. I like that. Then the regulator, you guys should change your approach and and consider the new IFRS 17. Thank you very much, everyone. God bless you all.
Yeah, thank you, Tosin.
Thank you, guys. Bye.
Bye.